If you're delaying your first withdrawal, you may be creating a six-figure tax problem. Most retirees miss it. At 6%, 1.2 million becomes 2.3 million by 73. That changes everything. In the next 10 minutes, you'll see when delaying helps, when it hurts, and the numbers deciding it. Here's the first honest number. A delayed withdrawal can raise your future RMD by $20,000. That matters because extra withdrawals are not optional. They stack on top of Social Security, pensions, dividends, and capital gains. Conventional advice says preserve tax-deferred accounts as long as possible. The math says preserve flexibility, not account purity. If you retire at 62 and wait until 73, you have 11 low-income years. Those years matter. Those are your control years. Once RMDs begin, your control shrinks and the IRS sets pace. This is where anxiety misleads smart people. Loss aversion makes the first withdrawal feel dangerous, even when delay costs more. You are not protecting wealth by never touching it. You may be postponing taxes into the most expensive years. Picture David and Ellen. Both are 62, retired, with $1.2 million in an IRA. They need $80,000 yearly. Social Security is delayed, and a small pension covers only $30,000. Their spending gap is $50,000. Many fill it from cash first because the IRA feels untouchable. So they drain $300,000 from savings over 6 years. The account balance still keeps compounding. At 6% growth, that untouched IRA can approach $1.7 million by age 68. Untouched. Looks safe, right? But by 73, the same balance can near $2.3 million before withdrawals even start. First year RMD, about $86,000 using today's divisor before counting $1 of Social Security. That is the honest trap. Their smallest retirement spending decision became their biggest tax planning mistake. Run the alternative. They withdraw $40,000 yearly from 62 through 72, and the ending balance changes. Use the same 6% return, the account lands near $1.7 million, not $2.3. Now the first RMD is about $63,000. That is $23,000 less income. Less forced income often means lower Medicare surcharges later. It may also keep more Social Security from becoming taxable. This is why first withdrawals are not failure. They are part of shaping the tax landscape before it hardens. The mainstream story worships growth. Retirement reality worships after-tax income because income pays bills and taxes decide net. That difference sounds small. Over 10 years, it can change spendable cash by tens of thousands of dollars. There is another hidden cost to delay. It shrinks your Roth conversion window exactly when conversions are cheapest. Watch that window. Some retirees briefly live in the 12% or 22% bracket before RMDs. That is not a permanent gift, it is a temporary planning window, and it closes faster than people expect. If you refuse to withdraw, you often refuse to convert. Both choices feel disciplined, and both can raise future taxes. People anchor to balance size. 1.5 million feels powerful, even if future taxes own 30%. That is present bias in reverse. You protect the statement today and hand tomorrow's tax bill to your older self. Your older self may be 78, widowed, or managing health costs. Complexity hits hardest when energy is lower. That is why honest planning pulls some money forward. You solve part of the tax problem while life is simpler. Now flip it. Suppose markets fall 20% the year after retirement and your first withdrawal scares you. That fear is normal, but delaying the withdrawal does not erase spending needs. It only changes which account absorbs them. That creates a second problem. Selling taxable assets after a drop can preserve future IRA taxes. A better plan uses buckets, not fear. Keep 1 to 2 years of cash, then refill strategically. For many retirees, that means a first withdrawal earlier, smaller, and deliberate. Not emergency money, planned money. Notice the difference. Delayed withdrawals are usually emotional. Planned withdrawals are mathematical, sequenced, and tied to tax brackets. You do not win retirement by touching nothing. You win by deciding which dollars should move first. Sometimes the right first withdrawal is from taxable savings. Sometimes it is from the IRA sequence matters. But delaying everything is rarely a sequence. It is usually avoidance dressed up as prudence. Take Maria. age 61, with $700,000 in a traditional IRA and $200,000 taxable. She needs $60,000 a year. Consulting covers $25,000, leaving $35,000 to source. If Maria delays her first IRA withdrawal, she stays comfortable today, but her conversion window shrinks immediately. Try the math. She withdraws or converts $30,000 for 7 years, moving $210,000 at modest rates. If she delays, that same money may later be taxed inside larger RMDs, same dollars. Worse timing. This is the contrarian beat most people need. Your first withdrawal is not the danger, random timing is. The honest number is not our return alone. It is return after withdrawals, taxes, premiums, and required distributions. That is why two retirees with identical balances can live very different retirements. Sequence and taxes split them apart. There is also a Social Security angle. Delaying benefits can be smart, but not if it means ignoring cheaper withdrawals. Some couples claim at 62 because spending from savings feels painful. That swaps a permanent benefit cut for comfort. A smaller IRA withdrawal now can protect a larger Social Security check later. That trade deserves attention. So do not ask only, should I wait? Ask, which future expense am I creating by waiting today? That question alone can save years of drift. Drift is expensive because retirement decisions compound quietly. Quick question for you. What age are you planning your first withdrawal, and why that age specifically? Put it in the comments. Your number may help someone else see their own blind spot sooner. Now back to the math. Because the first withdrawal is rarely about spending alone in retirement, it is usually about creating a repeatable income system. Systems reduce panic more effectively than large balances. And panic is expensive. It causes oversized cash piles, delayed withdrawals, and rushed decisions under tax pressure. Let us talk cash buffers. Many retirees keep 5 years of spending in cash because markets feel dangerous. 5 years sounds safe. At 4% yield versus 6% portfolio growth, that drag compounds quickly. On $500,000, a 2% gap is $10,000 yearly. Over 7 years, that matters. That comfort has a price. Oversized cash can avoid a modest IRA withdrawal while creating bigger opportunity cost. Again, this depends on your bracket and risk tolerance, but honest planning prices in idle cash too. A useful rule is simple: keep near-term spending liquid, but do not turn caution into a permanent allocation. For some households, that means 1 year of expenses in cash. For others, maybe 2, rarely 5. Why does that matter here? Because too much cash makes delaying feel easy, and easy choices often hide costs. Now add taxes again. If you are in a 12% bracket today, future forced income may land higher. Not because your returns failed, because you surrendered timing control when timing was cheapest and simplest. Now, withdrawal order. Taxable first, tax-deferred second, Roth last, gets repeated like a law. It is not a law, it is a starting template that can be wrong for your exact bracket. Suppose your taxable account throws off $15,000 of dividends and gains each year. That income already exists. Adding a small IRA withdrawal on top may barely change your bracket. Delaying may change it later. The better framework is bracket filling. Withdraw enough to use low rates intentionally, then stop before the next jump. That is calmer than guessing. It replaces vague fear with a number you can actually manage. A retiree in the 12% bracket might deliberately take $30,000 more this year. Another may take none. The difference is not discipline. It is what the surrounding income, deductions, and future RMDs look like. That is why blanket advice fails smart people. Smart people need thresholds, ranges, and triggers, not slogans. And your first withdrawal should be one of those triggers. It starts the system instead of delaying it. Here is another honest number. A $10,000 RMD increase can ripple into Medicare costs years later. Those premium cliffs matter because they are triggered by income, not by whether that income felt intentional. Delayed withdrawals often create accidental income. Accidental income is the most expensive kind because it arrives without planning. Planned withdrawals create options. Options are valuable in retirement because health, markets, and family needs never move in straight lines. Think of your first withdrawal as a test run. Can your paycheck replacement system work before life gets harder? If the answer is yes, anxiety drops. If the answer is no, you still have time to adjust. That adjustment might be smaller spending, partial work, Roth conversions, or a different claim age for Social Security. But you cannot improve a system you never start. Delay hides weak spots until options are fewer. This is where high savers get trapped. Saving skill feels transferable, but retirement needs spending skill too. The same habit that built wealth can block income. Discipline becomes rigidity when the goal changes. So when should you actually delay? Delay only when the next dollar withdrawn is clearly taxed worse today. There are exceptions. A pension spike, business sale, or unusual capital gain year can justify waiting. In those years, waiting can be smart, but smart delay has a reason, a number, and an end date. Bad delay sounds different. It says, I just hate taking money out, so I will wait. That sentence is emotional, not analytical, and retirement punishes emotional sequencing more than most people realize. A practical starting rule is this. The first withdrawal should happen when income planning becomes more valuable than account deferral. For many new retirees, that moment arrives on day one. For others, it arrives within 12 months. Either way, do not wait by default. Default is where expensive drift and unplanned taxes usually hide. Here's the bigger truth. Retirement freedom is not just having money. It is controlling when money appears. The system is confusing on purpose. Multiple account types, tax rules, and benefit rules can make smart people hesitate. That hesitation does not mean you failed. It means the decision deserves structure, not shame. So do one thing today. Write down your annual spending gap before taxes and your guaranteed income sources. Then identify which account should fund the first $20,000. Not eventually, this year. After that, ask one sharper question. Does delaying that withdrawal lower taxes or only delay the decision? If you want help with future scripts like this, subscribe. Calm numbers beat loud opinions every single time. Tell me this in the comments. What feels harder for you, spending less or finally spending on purpose? Because retirement is not a test of how long you can avoid your money. It is a test of judgment. And the calmest retirees are rarely the ones who waited longest. They are the ones who decided earliest.